Foord Asset Management has been one of the standard setters in the asset management industry, that being for the last few decades, a reputation that has been largely built on the back of its founder, Dave Foord. This evening, we wanted to find out the secrets behind the firm's success, and Mike Suku from Foord joins us to do just this. Warren, you've got some information for us at this point.
Yes, that's right, Bronwyn. We just wanted to bring up the consistency theme and really just talk to, when we do our research and analysis on fund managers, we look for consistency, and we just want to know that while the funds won't outperform every other fund all the time, we will have the opportunity to see a consistent performance. And so what I've done tonight is just brought up a couple of slides just to illustrate this and how consistent Foord's been over the years. The first one talks to the Foord General Equity Fund, and we don't really look at anything shorter than about 3 years to assess the quality of fund managers. You can see over 3 years it was the second best performing fund with an average of 22%. And what's great is that it's covered this consistency into longer periods as well. So even over 10 years, the fund's averaged 21.57%, which has been more than the all-share index. And even when we look at the Foord Balanced Fund, you'll see a similar vein coming through here. With performance over 10 years, it's the third best performing balanced fund over 10 years with a return of 18.15%. Now, the great thing about investing, Bronwyn, is that you can get so much info and insight from the investment managers themselves. And when Foord celebrated their 30th anniversary, Dave and the company published a little booklet, and in it they give a few insights into some of the success and some of the reasons why they've been so consistent over the years. And one of those I just wanted to bring out, he actually just tells investors to read the works of other famous investors like Warren Buffett and Peter Lynch and those people. And then some of the other ones I picked out here was that always be aware of the cycles. You know, always be aware of where the general economy is in a cycle and where a company is in its life cycle. So today we wanted to just get a little bit more insight on what's been the success behind Foord from the inside, and over to you, Bronwyn.
Well, Mike, you're on the inside, so let's see if you can share some of those state secrets. And as Warren said, it's all about that consistency. So how are you managing to beat the benchmarks out there?
First of all, thanks, Bronwyn and Warren, for having me. I think the thing that Foord tries to do, we don't try and shoot the lights out. So we just try and buy companies that we are quite sure of earnings 3 and 5 years out. We want to have predictable earnings, and I think that's the thing. Buying good quality companies, good management, good balance sheets, good cash flows, because if there is some kind of setback in the market, those companies are going to recover quite quickly. And often it's in those setbacks that these companies actually do better, because they're always on the front foot, they've got the strong balance sheet, banks are prepared to lend their money, and they can acquire. Whereas if you've got a weak company, a highly geared company, they're just battling to survive. So I think that's really it, just trying to buy good quality shares.
And holding on to those winners.
Absolutely.
I think that's a theme that we've discussed previously.
Absolutely. And I think that is it. A lot of people, for example, the retailers was a wonderful example a few years ago. They got to 20 PEs, and a lot of people thought they're too expensive and got out of their retailers.
Mike, you know, we talk a lot about styles of different investment managers, and we have growth and value styles and styles in between, valuation-driven styles and momentum styles. I've always asked Dave, you know, what sort of style does Foord follow? And it's always been a bit of a mix. So I guess for our viewers,
blended style.
Yes.
A blended style, yeah. So I think for the benefit of our viewers, you know, how do you sort of describe it? What's the sort of the underlying philosophy behind the approach?
You know, there's not a style. You can't put us in a box with the style. So sometimes we value, sometimes we growth, sometimes we would never be really a momentum player, but we a bit of everything. So we look. If we're happy with the business and we're happy with management and we can see growth for 3 or 5 years, we're very happy to buy that share. And Aspen's a wonderful example of that. Many years ago, we liked management, we liked what we saw, we liked the expansion plans, and we've held on to them for a long time. They were expensive at 16 Rand, at 40 Rand, at 60 Rand. They're now 160 Rand. Some people still say they're expensive, but we like the company and we will hold on to it.
And you think the company is going to continue to deliver?
Absolutely. We like what they're doing in South America, we like what they're doing in Africa, we like management and exactly that. So
I guess it's what you're saying. It's one of those things that's always very hard to evaluate when you look at companies, but it's as tangible as anything else. Is the sort of quality of the management and the strategy that they're pursuing. Do you think that the quality of management is almost like an economic moat for want of a better comparison with regards to the work you do.
Absolutely. If we're uncomfortable with management, we probably won't buy it. So even if it's in a sector that we like, because we do like following thematic approaches, but if it's a sector and we doubt management, because management can destroy value, so we would rather not buy that stock, even if it's in a good industry.
Just in terms of, before we talk about some of the funds and the stock selections then, and your view on the sort of general market, I wanted to ask you about the transition. Obviously, we stated in the intro there that Dave's been the sort of principle behind the firm and the power behind the firm, and much of the reputation of the firm is based on Dave's
And this
shoulders.
is something that concerns you, the succession planning. You've said before, Warren.
Absolutely, yes. It's always great to have a staff fund manager. In many cases, in a large environment, they get poached and they move to another investment manager. So your money almost has to follow the investment manager. Obviously, with Dave, he owns the business. He's in up to his socks. I wanted to see, though, how the firm now makes the transition from being a sort of one-man shop, if you could call it that, to an investment house like an Allen Gray that's got a reputation for outstanding investment management.
I think it's something that Dave recognized about 5 years ago. So he started this process of having to look at other managers in these different mandates. So about 5 years ago, we only had 3 portfolio managers managing all the different funds. We've currently got 7. So it takes us a long time to find the right portfolio manager. It's not that easy. They've got to be thinking similarly to Foord, taking the same long-term view. But when we've got them, we keep them. We look after them. When the board thinks it's right, we offer them equity in the business. So that's the way we are developing. So the company is less reliant on Dave than we were 3 years ago. And in 3 years' time, we'll be even less reliant on him than we are now. But he's an amazing manager. The younger portfolio managers love working with him and learning from him. And so the way we do business there is a succession plan in place.
Let's jump in now into a couple of your top holdings. And I've noticed, obviously, your exposure to the resource environment, BHP Billiton, Anglo American, do comprise or fall into your top 5 holdings. How long, just going back to your overall theory is obviously that you hold stocks you like, you back them for sustainable periods of time. Have these been long holds in your portfolio?
Yes. So most of our top 10 doesn't change month after month. There can be a few tweaks in that. Billiton we've had for a long time. And that's a typical company that we really like. It's got good management. It's nice, diversified. It's got all the qualities we like. It's got good cash flow. So Billiton we'll have for a long time. But as I say, with our portfolios, it's always trying to get that balance. So even though we've got those commodity shares in our top 5, we make sure that we're not just relying on we're not just a commodity, we're not just buying commodities. We've got our retailers, as we mentioned earlier. We'll have our banks. We'll have our non-commodity rand hedges, as well as obviously the commodity rand hedges.
So we've seen, that's a good point to touch on there. I mean, the retailers has been, it seemed to be such a two-sided story with the local investment managers. Most of them didn't touch them. They thought they were great businesses, but too expensive. Foord, again, was a little bit different there. You've been holding some of the retailers. Just update us on whether you've still been holding them to the same degree, following this little mini slump that we've seen in the first part of the year, or is there still plenty of upside? Is it an opportunity to buy some more? Exactly.
Maybe you've used the pullback to up your conviction levels.
Well, we certainly will use pullbacks because we do still like the theme. So to us, we like the consumer theme in South Africa. We think it was the one area when we did our strategy 5 years ago where we thought we could do well. Remember, you got in the public sector, you're getting above inflation increases. There's 13 million people getting social grants. You saw, I don't know if you saw in the latest FM, the average salary at Eskom is 650,000 a year. So it's good salaries, and they're going out and they're spending at the Mr. Prices and the Truists and the Fushinis. So we still like the theme. Obviously, prices now have run away from valuations a little bit, but the earnings are going to keep coming through, so they will derate. And if they come off a bit lower, we will look to buy some more. So we like the theme. It's not as if we're going to now try and get out and buy them 10% cheaper. We still like them. And also what it does is give us that balance in the portfolio. So if the rand stays strong, the retailers are going to do well. So it's always trying to, because none of us know the future, so you've got to try and make sure you've got that balance. And that's one thing I think also why we've performed so well, we never take a one love bet.
Okay, so I think that I just wanted to come in here because I think many of the portfolio managers we speak to have been very worried about the rand. And while I'm sure they agree that the future is uncertain, they are kind of hedging their portfolios towards a rand weakness or biasing their portfolios to a rand weakness. So at that point, is there any view on where the rand might head in the next few years?
Look, we do think the rand's going to weaken. Unfortunately, we've got this current account deficit. We're not productive enough. We're not getting these exports aren't happening. We still got our imports. So we've got a structural problem. But we've got these inflows that have been coming in over the last few years. And you don't know when those inflows are going to stop.
And of course, that's going to cause the volatility. I mean, if
Absolutely.
we suddenly see inflows translating into outflows, that's going to have an adverse effect on the local unit.
But you don't know. So we'd rather have some part of our portfolio balanced to the stronger rand, because you don't want to have this one love bet. So you could have 60% tilted in toward rand hedges, but you also want to make sure that if the rand strengthens, you're also going to perform well. So in absolute terms, we want to give our investors a good return year after year. We don't want to, do nothing and then nothing and then nothing and then try and, get 100%.
Let's talk about Sasol and your play. Obviously, the two biggest external drivers of Sasol being the rand dollar and the oil price. This obviously is something you've also held in your portfolio for a long period of time. Do you believe that there's going to be a value kicker for Sasol? A lot of fund managers out there saying that they're waiting for the international community to buy into the Sasol story, and that will create a re-rating of the stock.
I don't think so. I think, if you look at ExxonMobil, it's on an 8 PE. So globally, these stocks are cheap. But I think with shale gas and with these new sources of energy that they're finding, it's put a bit of a dampener on the sector. But what we've got in the portfolio for is very much as a protection. It's our insurance that in case there is trouble in the Middle East, Iran with their nuclear weapons, Syria is still a hot house. The Saudi family will face the succession plans going forward. So it's an insurance for that. It needs a weak rand. It's on a 5% dividend yield. So it's just nice to have it as an insurance in our portfolio in case the rand does blow out or in case there is trouble in the Middle East.
I think just to touch on another theme there, Mike, obviously you guys run international funds and invest internationally. What's the sort of valuation gap at the moment between our domestic stocks and offshore stocks? Is there a big gap?
Look, on average, our domestic stocks, if you take the resource stocks as well, aren't that expensive. So we're probably on a 15 PE, and globally you've got these global stocks on a 14 PE. But you've got these global international stocks. We are quite positive, or a bit more positive on this global economy. So we want to be in those stocks. We want to get exposure into that Asian consumer. And so we want to be owning the Nestlés and the LVMHs and the Diageos and that kind of stock that can benefit from that growing Asian consumer.
Yeah, you're going to continue. So the retail story is not just a local one, it is a global one that you're going to be following.
Yes.
And
Absolutely.
the Africa exposure, are you excited about the Africa themes?
Not really. It's quite difficult to invest in Africa. There's not much liquidity in those markets. It's quite difficult to know where to go. So it's really something we've avoided, and we'll get some kind of play into that through our retailers. And I think that's what people also forget. The retailers has become, when these overseas investors invest in our retail stocks, they're not taking a 3-year view and wanting to sell when it gets to a 25 PE. They're actually taking a multi-decade view. They're looking at our retailers as this growth into Africa for the next few decades. So,
Mike, we're out of time, but we're going to have you back in studio very soon. Thanks so much. Mike Suku is Head of Retail Business Development at Foord Asset Management.